Hello everyone, welcome to the Do More of Your Money podcast, episode 159. Can't believe we got there, Mark.
We did, Jimmy.
We did, and I can't believe actually they've allowed me to do two in a row. Normally I do one and then I get asked to sort of stay away for a few weeks, so really pleased to be back. Welcome everyone. I don't think any introductions are needed. Welcome to the budget special. We've had an interesting week. Obviously with some great changes in the budget. Some good updates to pensions, which we'll get into a bit of detail for. But I think it would be remiss not to talk around the markets this week, and we've got Jeff here just to give a little bit on that. I think. First of all, Jeff, can you just please tell us who FVB are? I think before this week, most people probably hadn't even heard of them.
So SVB, they are a bank in the US, 15th largest bank in the US, a balance sheet of some $200 billion. They're, I suppose, a specialist regional bank, one would call it, in Silicon Valley. They have grown very rapidly over recent years, which was, I suppose, a positive from their perspective. But as a bank grows rapidly and takes money in, as in deposits, it has to do something with that. So it either lends it on to customers who borrow or it invests it. And really what we've ended up with, and over the course of last week it became very clear that there was quite a significant mismatch between everybody wanting their deposits out and the ability of the bank to sell some of those investments that they've made with them, resulted in losses and eventually the bank becoming insolvent to, on Sunday evening, the Federal Deposit Insurance Company taking control of the bank and guaranteeing all of the deposits. And really that had been the concern at some points over last weekend, that what would happen to the depositors. Much like in the UK, we have the FSCS scheme, so the compensation scheme. In the US there's a similar scheme as well, but for those that were above that, there was a concern. And that was important in the case of Silicon Valley because of some very significant deposits from high growth technology companies that had been there. So really in terms of, that was the start of the end of last week, the weekend, and that sort of morphed into some general sort of challenges that we're starting then to face a number of banks. As you see, banking's about confidence. Deposits are crucial. People started to move deposits around the US system, and particularly the regional banks, and I think that's an important aspect for us to bring out, that these are regional banks in the US, and that's important from a regulatory perspective. Post 2008, we had quite significant regulatory change that focused on the largest banks, so they became systemically important financial institutions, SIFIs, and they are regulated in a very different way, to a much higher capital standard and liquidity standard, and also crucially in the case of their mark-to-market book, i.e. where they retain these investments, they mark them to market through the balance sheet on a quarterly basis. A regional bank in the US doesn't. And that's the key difference that we have to bring out. That was regulatory change that came through in the US, I think around 2018, to exempt some banks from that. But clearly, when you've got a bank as large as that, and as a mismatch that it had, that needs to be addressed. As we then followed that through, I suppose it became Credit Suisse in Europe. And then we saw the Swiss National Bank come out and put a backstop really around Credit Suisse, with some 54 billion of facility available for Credit Suisse to be able to draw down should it be required. And then it did require it, and so it drew it down through Thursday evening as we come into the market yesterday. And that has gone some way to sort of stabilising a little bit of sentiment, I would say. It's far too early to say it's changed the dynamics. We still need to work through that. Overnight, we've heard of an arrangement in the US for a bank called First Republic. Again, a regional bank focused in the similar area actually as Silicon Valley Bank in terms of its deposit base. We've seen the large US financial institutions this time come in to place deposits into First Republic. So we've got an arrangement where $30 billion is going to be deposited in by all of the list of US banks. So JP Morgan, Bank of America, Citi, Wells Fargo, they're all contributing $5 billion, and then the list goes on in terms of others. So a lot is being done in the background by regulators and by the financial institutions to try and isolate these challenges for some of these regional banks, which really is just about deposits and keeping deposits in the banks, because banking, as we know, is about trust, and it's about people having the trust to deposit their bank, to deposit in these banks.
And I think the thing I've realised from this week, Jeff, is how quickly things have changed. You and I were discussing on Saturday evening about, in terms of what types of communications we send to clients about the SVB situation. You were a good note on Sunday, and it was out of date by Monday because it was taken care of overnight. So there's been very rapid movement, and
there has, and I think that also it's worth saying that that's central banks and bankers learning, I think, from previous problems. So we go back to 2008 and think about that. I think the other thing is just really how markets react to these things. It's very much straight into markets. So volatility this week has been exceptionally elevated, both in terms of, and more so, we all think about it in terms of, and we see it very front and centre in the equity market. But really, I'd probably contend equity markets have been relatively well behaved, given what we've seen in sovereign bond markets in particular. And that has been one of these challenges, that bond markets exceptionally volatile. Equities, yes, have been down over the course of the week as well. But from a bond perspective, the volatility has meant their prices have increased. So the yields have come down quite a bit. And that's been a positive to see in terms of how we think about multi-asset portfolios and wanting to have those degrees of offset, if you will, when we're seeing that being challenged in an equity context.
And I think just finally on this point, from a true potential and portfolio perspective, Jeff, I think it's important to just let our sort of listeners understand and know is, yes, we've been doing things at the top end in terms of looking at this, but also our managers underneath.
Yeah, certainly, and I think it's very clear to me it's very difficult to take action in such a volatile time, and we have seen where our managers have been identifying potential areas where they want to change the shape of their portfolios. They have been doing that. I think one of the things that we would always think about is you've got a strategic asset allocation. With the magnitudes of the moves that we've seen within bond markets this week, it's given some managers the ability to move back to their strategic asset allocation model, so take the profits that they've actually earned and reinvesting those in areas of the market that have been weaker as well.
The other side of it, Jamie, to consider is, and we got a few questions early in the week about exposure to Silicon Valley Bank within the portfolios, and when we look through, as you know, we can see through right down to individual holding levels. We don't have any direct exposure to the bank. And the other thing to bring out is that the US banking system for retail deposits is much different to the UK and Europe. You know, Jeff threw a little question at me the other day saying, how many regional banks do you think there are in the US? So a wild stab. And it's, how many do you think there could be, Jamie?
50, 60? Am I low?
You'd have to multiply that up quite considerably.
Oh, wow, okay.
Over 2,000.
Wow.
Now they've all, as we go down the list, they're very small in size and very niche, but yeah, there is over 2,000 banks.
Because you can, in the UK, you would say, there's like 10 banks, then all of a sudden you're seeing challenger banks come in, but that's
so there's various different entities have banking licenses, and as that goes down through the system.
Interesting.
It's quite an amazing statistic when you think about it.
Yeah. I think the key for me is, which with the volatility, sometimes actually doing nothing is the best thing to do. Which from my perspective as a personal investor, it's kind of when logging into your site and seeing your valuations, I kind of took a week off it, if I'm being quite honest. And I think sometimes that is the best thing to do.
I agree with that, Jamie. I think on Wednesday we saw a significant drop in the FTSE, nearly 4%. I think this morning the FTSE's up over 1% last time I checked, and I think on Thursday it was up by over 1% as well. So it just goes to show, if you did panic on Wednesday and crystallise a loss there, you would have missed out on smaller gains over the next 2 days.
I think it's worth just expanding on that as well, Luke, because we get again questions about diversification. If we're purely invested in FTSE 100, it's so heavily weighted to banking, to mining, commodity, etc. It wasn't just banking that forced the decline earlier in the week. You had the oil companies were down significantly as well. So that had a bad effect on FTSE 1 Dave this week. As you say, it's rallied again and it's come back as we are now.
And I think that's the important point about what was happening during the week and how it kind of morphed from what we were seeing on Thursday and Friday to something that was about just US banks and a challenge there. It wasn't just about European banks. I think on Tuesday and in particular Tuesday and Wednesday to an extent, basically it felt that there was just people selling everything that they could and moving assets just into to sovereign bonds and that speaks to the type of environment that we've been in, the availability of liquidity, the availability of leverage, and how that's fed into the financial system.
One thing that it did show, and it's a return to what you'd expect to be more normal market conditions, was the negative correlation.
Yeah, the correlation between equities and bonds was really quite noticeable this week, i.e. the negative, where equities weakening, sovereign bonds.
And we've seen them move together in recent months, haven't we? And this is one of the things when you're having a diversified portfolio. And
I think it's an important point to draw out, because we spent a large part of last year thinking about higher inflation, higher interest rates, and at the same time we were seeing equities weaken and we were seeing sovereign bonds weaken over the course of this week, particularly where we've seen this more extreme, if you wanted to think about it like that, in terms of a financial condition. Sovereign bonds have provided the ballast that one would want them to provide in a portfolio.
Great, thanks, Jeff. We'll just quickly on that. I think for anyone that wants to know more information on markets, watch the Mono Market videos. They've been very useful for me personally this week. But also, obviously, speak to your financial advisor or ring us. We'll be happy to talk you through in a bit more detail. There's lots of commentary that's been going around to help people understand this. So appreciate that. We'll go through that. Okay, let's budget week. And I think I remember when pension freedoms came in, Mark. Pensions became sexy again. Maybe. But actually, we've seen some really good changes this week, I believe.
There's been some changes, Jamie, and there's lots to consider here. The removal of the lifetime allowance is a positive for everybody in the UK, not just doctors, etc. So I think that the fairness that needs to be applied here is, if it's good for one group of the workforce, it's good for everybody. We can't have tailor-made pensions. That's not right. It's not fair.
Totally agree.
So I think that we need to look at that, and we need to encourage people to save into their pensions. When you look at the small print, and everybody said about the budget, the devil's in the detail. And part of the detail is, at the moment, you can take 25% out of your pension tax-free. That is limited to the old lifetime allowance, which is 1.073 million. But I think it's time now to challenge what was in the past conventional wisdom before pension freedoms, where the default was to automatically take that 25% out of your pension. With pension freedoms, you don't need to do that. You can leave the money in the pension scheme to grow tax-free for as long as possible. Now, draw on it, yes, when you need to, but don't take the 25% out unless you absolutely need that. And that's a conversation for everybody to have when they come up to retirement age.
I'd agree, Mark. Yeah, in terms of even the pension is the most tax-efficient product you're going to have. You take the full tax-free cash out, which was always a historic view. You're removing it from a tax-efficient asset and you're potentially placing it in cash or slowly in ISA as another product. So it's definitely worth intending to keep it in the pension for as long as possible. In terms of a lifetime allowance, as a PTS, I've now essentially got a lot of useless information in my brain that I don't need anymore. But for anybody that doesn't know, essentially it's a tax charge. It was either 25% on income or 55% on lump sums. And that's now going to be completely gone by 2024.
I was just laughing because Luke and I are PTS, pension transfer specialist, and basically part of our examinations that we had to complete was to be able to calculate lifetime allowance charges, and I've spent many of the hours studying, as you probably
all the
have,
different protections,
being
and,
able to understand and work that out for a client.
Correct.
And it was now all those hours now have been
It's
gone.
at least it might free up space in my brain for someone else to
true.
learn. But I think it's great for clients. You know, clients always had concerns over this tax charge because you had to pay it, whether you're going to spend the 1.073 million or on death. So now, for anybody with a large pension, it also affects people with defined benefit schemes, whereby you would times the income by 20, and that would be the amount that you would test against the allowance.
Can you just explain what lifetime allowance is? So I know it won't affect every pensioner, every client with a pension that we have, but I think it's worth just explaining what that tax charge was, and the difference it could make to.
So the headline figure is not mentioned 1.073 million. It affects both people with money purchase pensions and defined benefit schemes. Once you go over that amount, either on death or you crystallise and take that amount as income, you would pay previously 25% on any further income or 55% on lump sums. So some quite heavy tax charges really when you think it's also taxed as income on top when taken as income. So for a lot of clients, this is a huge concern with large pensions. People potentially not putting in any more money into their pensions when they're coming to retirement and giving up on employer match contributions. So for me, I always said to clients, look, this could change in the future. It was only 2 years ago when the same government froze the lifetime allowance and said that it wouldn't be increasing with inflation anymore. So to actually remove it's a huge thing. It's a massive change, and for any clients who have that level of pension, it's a great incentive to save more, to put more into that pension, take advantage of employer matching contributions, speak to your advisor and save more past that, because you're not going to pay that tax charge anymore.
And that adds to the Mark, you talked before about adding money into your pension as well. They've obviously increased the amounts that you can put in, which is, I think, is a positive.
Of course, it's a positive, Jamie. It encourages people to make a decision now to save for their future. And if you just take you two fellas here, the youngest in the room, if you want a pension of £50,000 when you retire, if you just take a 5% withdrawal from a pension fund, you're going to need £1 million in your pension. Yeah. You're going to be hit by the lifetime allowance. Yep. So it's not just for people who are 50, 55 to 60. Agree. It's for everybody, and it's an absolutely pointless allowance to have. Part of what we were going to say was perhaps it should be on contributions. That was the script that was in my head, ready for the budget. To take away the lifetime allowance can only be positive for every generation.
Yeah, I totally agree. And it also just strips back the complexities of pensions. And I know I was joking a little bit about the pensions becoming a little bit sort of sexy, but actually what you find is we've went from a position where they were very, very complicated. They've stripped them back a lot with having the ability to affect your pension freedoms, and now it's kind of just let's just strip away more things that you have to discuss with clients.
Can I confess, Jimmy, I feel a little bit creepy when you say that.
No,
it's not a good thing, is
Twice.
it?
I quite like it. It's a good one. Just on the obviously we've got the two increases on the pension with the 60,000, obviously increasing from 40,000. There was others as well. Do you want to just go through?
Yeah, of course. So the annual allowance is the amount that you can benefit from tax free and benefit from tax efficiency when putting into your pension. It's been frozen at that level since 2015, 2016. So it's good that they've increased that. Yeah. It means that anybody approaching retirement who earns that sort of level of income can place more into their pension and also benefit from carry forward as well. So it's a massive incentive to put more in, benefit from that tax relief, and it's good news that they've increased that. So it means you can put more into your most tax efficient asset. The money purchase annual allowance is a little bit different, so that's for anybody who has taken an income from a pension. So an example I would use is somebody who maybe has semi-retired, taken an income from a pension, decided to go back to work, which we're seeing more of now, or go back to a part-time job. Previously they could only put £4,000 a year into their pension, and that's increased to £10,000 a year now. So it's good news for anybody who's taken income as well. They can put slightly more in. The tapered annual allowance, that's going to affect less people. This is for high earners. Anybody who used to earn £240,000 a year sees their annual allowance reduce by £1 for every £2 that they earn, and that's increased to £260,000. So some good increases there. The big one, obviously, the annual allowance for working people who haven't access to pension. It means you could put an extra £20,000 a year into your pension to save for retirement.
Do you think the aim in the budget, there was big talk prior, Mark, was around getting people back to work, and having a budget that encouraged people to get back to work. So that rise from 4,000 to 10,000. Do you think that's enough?
I think, Jamie, there's got to be limits somewhere. The more people who save for their own retirement and are investing in themselves to begin with, to give that degree of choice when it comes to retirement, that's good for the individual, but it is also good for the state, because it means that there's more money that isn't being drawn down in benefits to help those who really need them. So I think that you can argue both ways for it. If it was totally uncapped, there could be some abuses in there, but I think that the benefits of it more than outweigh. And whether or not that particular example, the limited at 10,000, is right or not, I really don't know how many people it would affect. But if you can put more into your pension, just go ahead and do it. Do the very, very maximum. And you've got to remember that the budget spends money, but it also has to raise money. And corporation tax is still going up. That's going up to 25% from 19. We'll be paying that as a business. The other thing is alcohol duties going up, except for draft beer in the pubs. So that's handy for you, because we had a conversation about Guinness just before we went on air. And then there's no changes to the income tax or the capital gains tax thresholds. So money is coming in to cover the spending. So pensions, yes, they get the headline, but there's other areas to look at as well.
And the corporation tax one's quite, it's a big change. We say 25%, but it's a third higher. That's quite material for business, and whilst there is some offsets around it, it is quite a step change in that taxation level. And I suppose the other things that are there, to your earlier point, Jamie, about encouraging or trying to encourage people back to work, is the childcare provision and opening that up for kids that are over 9 months now, so bringing that down to that cohort as well.
I think we talk about the younger people, actually that affects Luke and I, who have both got young children.
And I nicely brought it in place, so it comes into play when my little one just turns 3, so just miss out on it, Jamie. So a little bit.
I actually haven't looked at the devil's in the detail, as you say. So
the phasing in from next year, and then by 2025 is when everybody. But look, for me, in my social circle, that's going to be a huge change. So for me personally, our childcare bill is our biggest bill per month. So it's money that was going towards your child anyway. And my thoughts on, you could use that money, you could spend it on holidays or yourself or whatever, but you could save and invest it for your child, because it's money that you were spending anyway. You could use something like a JISA instead and stick it straight into there.
It's interesting for me personally, kind of look from a personal perspective. Obviously, I've got 2 now, just had a little one a few weeks ago. And one of the considerations we made when Jack first went to nursery and my wife was working was, you were considering, well, this is how much the nursery fees are, and this is how much the earning was. And I kind of, my wife wanted to go back to work, she's a teacher, she wanted to do that, but you kind of did the basic maths, and it sometimes didn't make sense. So this actually is a help. I think it will be a help to lots and lots of people.
It'll be a big encouragement to get people back to work and take advantage of that free 30 hours, because like you, we had that discussion as well with the cost of childcare being what it is.
The other thing on back to work, less direct, is the investment zone announcement, which kind of grows on the Freeport idea that's been floated. We discussed Freeports here within the building. I know David was very, very keen on the idea of the establishment of Freeports across the UK, and it looks as if that's going to be extended through the investment zone idea. But again, there's red tape in the way, there's bureaucracy, but when you're spending government money, I suppose it's inevitable that will happen. So we've got the named shortlist in England, and then it has to follow in Wales and Ireland as well, and Wales. So it's up to the devolved governments to make decisions on this. But hopefully it'll generate high quality jobs in specific areas in the UK.
It's interesting. A question that you'd normally ask around this time when the budget comes out, and this is how do the markets react to the budget? But
I think this week we've been the budget has been somewhat overshadowed in a market sense about what's been happening. I suppose if you take that step back and you think about what it's trying to do, it's trying to engender savings. That savings engendering it is important because that is investment, and that actually will work its way through into the economy at some level as well. So there is that two sides to it, but in the eye of this week, from a market perspective, it's been somewhat lost.
Yeah, think it's a positive budget, Mark? Good budget, or
As far as budgets go, yeah, I think it is, Jamie, particularly on the pension side, and hopefully investing money for growth, because without growth you get stagnation, and that just leads to a downward spiral. So if it's a linear decision, yes or no, or sorry, a binary decision,
yes.
My binary decision is yes.
Yeah,
It's a very steady budget. It's probably, if we think back to how things evolved post our last budget, or our budget in our mini budget, whatever we want to call it, in September. Clearly, this is just very straight back. This is what we're trying to do. Let's move forward.
Feels very much like the individuals that made it, doesn't it? In terms of how they're trying to
very much
ensure calmness and straight.
Yeah.
But
If it's a case of lessons learned,
yes,
I
think so.
The lesson has been learned.
Yeah, I certainly think so. I think we'll just go back to, just quickly, I just want to go back to pensions, because I think this is, something we should talk around inheritance tax, and this is a big encouragement for people to keep actually money in their pension.
Correct.
We talk about this quite often, where naturally you come to the assumption that your pension's there for your retirement income, and you've got other products, but actually it's a really great vehicle for people that potentially got inheritance tax.
Yeah, so
outcomes.
one of the things that was announced, the inheritance tax threshold is going to stay the same.
Yep.
So for a married couple with children, they have $1 million to benefit from in terms of inheritance tax.
And that's including your property, Luke. I think that's
Exactly.
quite
So
important.
if you look at the average property price in the UK, but if you're living somewhere like London, in a normal average house, that could be worth there or thereabouts.
Yeah.
So for a lot of people, there is a concern of inheritance tax, which is going to be a 40% tax charge. With the removal of the lifetime allowance tax charge, meaning that you can have more than $1 million in your pension, it's a real incentive to save cash. And obviously you've got the enhanced annual allowance now of £60,000 a year. You could move assets from your estate, cash, property, etc., sell down and put into a pension, as long as you're within those sort of limits. So yeah, it's a real driver to save money within a tax efficient asset that you can also pass to your family tax-free on death as well.
And you've got the tax relief as well. The
Correct,
additional tax relief. So there's further benefits
sorts
to it
of
as well.
advantages there,
So I think just to kind of just plug in there as well, as if a lot of these changes are coming in at different points, so just worth just speaking to your advisor. These things become relevant to yourself, speak to us. We'll be happy to talk you through it. We'll, especially on the lifetime allowance and these changes, we'll be sharing some information with clients in the next few weeks, just to how that could affect you personally, and how we can help as a business, to really help clients achieve their goals.
I think, Jamie, also you're talking about in the next few weeks. In the next few weeks, we get to the end of the tax year.
Yeah.
So if there is one message, make sure you've used your full ISA allowance, make sure you've put as much money as you possibly can into your pension, and then start again come 6th of April.
And I think this is a really good point on this, that it's we always say tax year end, this is when it ends, but you've got a full tax year, so there's two opportunities here to really sort of take care of things. Yes, you've got your ISA allowance, you've got your pension allowances that you can use, your junior ISA allowances as well. Don't forget about those. That's something I personally set mine up at this minute in time. So please do use those. And I think just to kind of remind people how you can do that, we've got obviously the impulse save functionality, which is, I would say, is the best way of topping your money. And so if you haven't already done that or haven't considered doing that, speak to the team, speak to your advisor. We have a short period of time left to do that. I think it's really important. But after tax year end, you've got a brand new tax year, so use that opportunity. April's also a good month to start, as well as so you're not rushing around.
Yeah. Just on the capital gains tax as well, that's the planned reduces going ahead, so only 3,000 capital gains tax allowance ties in with tax year end. If you do have any assets which might suffer from that, it's a good time to sell down it and get those into something like an ISA, which won't suffer from capital gains tax.
There's an option on your website to first of all pop money directly in your ISA if you've got cash savings and you want to do that. If you haven't, but you have a general investment account and you've got an ISA open, it's actually worthwhile, as long as there's no it depends on personal circumstances, but as long as there's no gain, you can move your money from your GIA to your ISA into a tax vision. And there's a button on the website that facilitates that. Speak to your team, speak to your advisor. That also is a great option. Brilliant. I think that's a good session, everyone. I made Mark feel uncomfortable twice, so
Still time.
so
That's right. What time's it, Jimmy?
I
20
know,
past
so,
9.
yeah, it's normally 3 or 4 times by
Yeah,
this
that's
stage.
right.
I did try and open a Guinness since it's St Patrick's Day right at the start,
Yeah.
but I was told I wasn't allowed to. It was Jeff that was encouraging it because I know he's an avid Guinness drinker. But yeah, no, thanks very much. Hopefully, some good content there for everyone around the markets right at the start, but also just to kind of summarise from a budget perspective. Lots of positives. Lots of positives from a pension perspective. Hopefully, we'll give some clarity along that, but also plug it again. Don't forget tax year end. Get your savings in. Use those allowances. You will lose them. So worth using them straight away. So thank you very much, gentlemen. Hope you have a great weekend.
Cheers.
Thank you, everyone. Thank you for listening.